How to plan for a long-term property investment. Property investment is a popular investment strategy. While more intangible assets like stocks and shares rise and fall on distant markets, property provides a reassuringly physical asset that many people can understand and relate to. Investing in property isn't a guarantee, but it has historically offered a chance for valuable return on investment or ROI for many market investors. That combination of physical asset and positive sentiment means property remains one of the more favored long-term types of investment for many who invest long-term in property. Long-term property investment is undertaken by a variety of investors with different backgrounds, financial resources, and goals. What fundamentally links them is a belief in the returns that they are most likely able to receive after an extended period of time. These kind of property investments aren't for get-rich-quick investors. They are considered investment that takes into account the potential return over a substantial period of time. Some property investors can hold on to their assets for many decades before deciding it's a point where they desire to sell. These investors include institutional investors, wealthy family investors, high-net-worth individuals with expanding property portfolios, even parents who have strived to earn enough capital to invest in property to deliver future returns to their family. How to plan for a long-term property investment. If you're considering a long-term property investment, there are a few things you need to do to plan for success. 1. Set your goals. What do you hope to achieve with your investment? Do you want to generate income, build equity, or both? Once you know your goals, you can start to develop a strategy to achieve them. 2. Do your research. Before you buy any property, it's important to do your research and understand the market. This includes understanding the local area, the current market conditions, and the potential for future growth. 3. Get professional advice. A financial advisor can help you develop a sound investment strategy and make sure you're making the most of your investment. 4. Be patient. Long-term property investment is a marathon, not a sprint. Don't expect to get rich quick. Be patient and let your investment grow over time. If you follow these tips, you'll be well on your way to success with your long-term property investment. Why invest long-term in property? Property investment has powered some impressive returns for investors, particularly in the booming years of the 2000 to 2012 period. While no investment can ever be guaranteed and must be made with a recognition of the associated risk, this view of property as a secure avenue for returns means it remains popular with a wide range of investor types. While commercial property offers a great avenue for investment for some, residential investment is the most accessible path to property investment for many, and it's one that's had some notable success stories. Hugely popular residential areas have enjoyed substantial growth over the last few decades, leading to a growing public belief in the potential returns in property investment. Industry figures show that a condo in the popular Bangsar suburb of Kuala Lumpur could have enjoyed capital appreciation of more than 160% in the years from 2001 to 2017. That's a return that's hard to beat for many. How to invest in property long-term. Property investment can generate returns in two main ways, and it's important to understand those opportunities before considering a property investment. Capital return is return on investment realized by the rising value of the property you own. It essentially accounts for the increasing value of the asset itself. For example, if you buy a property at $100,000 and sell it at $400,000 a decade later, the simple capital return would be $100,000 or 100%. Rental return is about a flow of income generated by your property during the period of ownership. If you're investing long-term, there's a good chance that rental return will be an important part of your investment consideration. Of course, if you're buying the home for a family member to live in, this might not always mean rental payments will be part of the equation. The pros and cons of long-term property investment. If property investment is a certain return, then why isn't everyone doing it? The truth is there are pros and cons to long-term property investment, and deciding whether it's for you might be down to several factors. Pros: potential for high returns. As mentioned above, property investment has the potential to generate high returns over the long term. Tangible asset. Property is a tangible asset, which means it's something you can touch and feel. This can be appealing to some investors who prefer to invest in assets that they can see and understand. Diversification. Property can be a good way to diversify your investment portfolio. By investing in property, you can reduce your risk by spreading your money across different asset classes. Cons. Illiquidity. Property is an illiquid asset, which means it can be difficult to sell quickly. This can be a problem if you need to access your money in a hurry. High costs. Property investment can be expensive. You'll need to factor in the cost of buying the property as well as the cost of maintenance and repairs. Risk. As with any investment, there is always some risk involved in property investment. The value of property can go down as well as up, and you could lose money if you sell at the wrong time. Ultimately, the decision of whether or not to invest in property is a personal one. You'll need to weigh the pros and cons carefully and decide what's right for you. Benefits of long-term property investment. Physical asset. You have a physical asset that you can see and touch. This means that there is very little chance of it suddenly vanishing into the air due to fraud or financial mismanagement. Historic capital appreciation. While Malaysia's property market has slowed in recent years, there is no doubt that property is still broadly expected to enjoy long-term capital appreciation. This means that many people continue to commit to the long-term capital returns that property could realize. Chance for high returns. The example of a Bangsar condo shows how substantial the potential can be for good returns if you purchase property in the right area and at the right time. As ever, there is no guarantee you'll get it right. The more you know, the better equipped you are to make the right decision. Financial leverage. Property is a class of asset that enjoys some unique elements of financial leverage through the established house loan system. Loans from financial institutions are readily available which assist you in investing in this asset class, boosting your investment potential. Dual income potential. The potential for ongoing rental returns alongside capital appreciation is an enticing prospect for many investors. This works to complement the possible financial leverage from accessing a home loan by providing an income stream to offset loan costs. Positive sentiment. Property ownership is often seen as an aspirational thing, which means it offers an asset class that adds additional sentimental value to an investment portfolio. Property investment can be a good way to build wealth over the long term. However, it is important to do your research and understand the risks involved before you invest. The drawbacks of long-term property investment. Not a liquid asset. Property is not a liquid asset, which means it can be difficult to quickly access cash that is tied up in a property. If a sudden life event means you need rapid access to cash, it can be challenging to do this with property. Substantial cash tied in one place. While bank accounts allow you to withdraw part of or all of your asset in one go, property tends to be more of an all-or-nothing affair. Liquidating the cash value of property is generally a case of selling the entire property. Management required. Some investment types such as bonds tend to live out of sight and out of mind. Property, on the other hand, can be a fairly demanding asset, especially if you're renting it out. While you can hire agencies and professionals to help with much of the necessary, that does come with a cost. Ongoing costs. Maintenance, management, and upkeep of your property is vital to its ultimate investment return. Keeping your property in good repair means ongoing costs throughout the course of the investment. No guaranteed return. While an investment bond might guarantee a return of 5% against the original deposit, there is no such guarantee with property. It may be that a market downturn or overall costs of upkeep mean your return on investment falls below the 5% return that was guaranteed against that bond, or other investment types you considered. How to plan for a long-term property investment. Investing in property can be a great way to build wealth over time. However, it is important to plan carefully before you make any investments. Here are some tips on how to plan for a long-term property investment. 1. Explore the value of the property. Compare the current house prices with historical trends to see whether an area has enjoyed capital appreciation over time. Is there a sharp rise that has steadied out, therefore indicating a mature and stagnant market? Have property prices fallen, indicating a good time to buy? Is the market generally on the rise? The more you know, the more informed your investment. 2. Look to the future. Look at the emerging potential of the neighborhood, comparing it against other suburbs that may show similar amenities and infrastructure, but at a more advanced stage of its life cycle. Is there any insight here? 3. Calculate loan costs. If you're taking out a home loan to finance part of your investment, you need to consider how the overall loan costs might impact your eventual financial return. That's especially important when you consider that interest rates can, and often do, change, which may substantially alter your ongoing repayment costs. 4. Consider the potential to add value. Is the house in need of fixing up? Will you be able to develop a better garden? Can you gradually invest to expand areas or extensions of a landed property? Consider value factors, and once again, research in detail how they might impact the price over time. 5. Consider rental alternatives. Not all rental alternatives are made equal. You could rent to students, long-term tenants, holiday rentals. They each come with their own benefits and drawbacks, so research which type of rental works for you and understand what that means for your finances. You have to consider secure long-term nets versus potentially volatile, but higher yielding short-term returns. 6. Don't forget the hidden fees. With long-term investments, things like stamping duty or legal fees are less of a substantial consideration, but that doesn't mean you should discount them. Factor in all the costs to your initial calculations. 7. Estimate ongoing costs. Management fees, maintenance bills, insurance, these all cut into your ROI. Make sure these ongoing costs form part of your overall equation. 8. Consider the tax. Tax will impact the return you receive and any other relevant taxes at the time of purchase or potential sale into calculations of your projected return. 9. Speak to the professionals. When you're investing hundreds of thousands of ringgit, it's important to think carefully to understand what you're doing. Speak to the professionals, whether that's real estate agents, property lawyers, financial advisors, etc. So, when is the right time to sell? The most challenging part of a long-term property investment is understanding when it's time to sell. For some investors, that choice is part of a natural life cycle. They sell their asset when the time is right for them, such as to pay for a child's college fees or to unlock capital for their own retirement. However, this choice can be at the mercy of market forces during times of a particularly slow market. It's important to keep an eye on the trends and prices within the local area. Monitor property sales in the neighborhood, particularly those with similar property types. This will give you an important understanding of transactions and how prices might relate to your own investment. If there's a particular surge in prices within the local area that then levels out, it might make sense to sell your investment and free up the capital to access potentially greater returns in other areas. Property investment is an exciting opportunity, but it is never one where you can guarantee returns. The more you know and the harder you work, the more likely you are to realize the benefits of your investment. I hope this is helpful. Let me know if you have any other questions.